Financial freedom means having a steady income stream that doesn't require constant work. To achieve this, you need to build assets that generate enough income to cover your living expenses. But what types of assets can offer not just cash flow for your expenses, but also shield you from market downturns and inflation? In today's video, we'll explore 5 assets that can help you quit your job. Before diving in, please like the video and subscribe for more valuable content like this. Let's get started. 1. Dividend stocks. Owning shares in robust companies can provide a regular income without active effort. These companies distribute part of their profits to shareholders in the form of dividends, essentially cash payouts. Dividend amounts vary between companies, known as the dividend yield. For instance, Apple's dividend yield is under 1%, while ExxonMobil's is above 3%. This yield is a percentage of the stock's price. For example, if a stock has a 3% dividend yield and is priced at $100, it would pay you $3 annually per share. Remember, the dividend yield is just one factor when purchasing stocks. It's also crucial to invest in financially sound companies with a positive outlook. Building a steady dividend income is typically a long-term strategy, unless you have significant capital to invest. For instance, with an average dividend yield of 3% in your portfolio, generating $1,000 per month in dividends would require a $400,000 portfolio. Therefore, for most, dividend investing is a long-term strategy. Many investors use compound interest and reinvest their dividends to grow their investments over time, eventually leading to a substantial, regular income. Despite being a long-term approach, dividend income is a valuable addition to cash flow, as it is quite passive and taxed at a lower rate compared to regular income. 2. Cash flowing real estate. Real estate is often cited as a prime way to build wealth, and there are solid reasons for this. Firstly, real estate generally appreciates over time. For example, in the early 1990s, the average home in the U.S. cost around $97,000. Today, the median home value exceeds $400,000. The market value has more than tripled in the past 30 years. Secondly, you can acquire such assets without having to fully fund the purchase yourself. For instance, if you buy a house for $200,000, make a $40,000 down payment, and borrow $160,000 at a 2.5% interest rate over 30 years, your monthly expenses for mortgage payments, interest, insurance, and taxes would be about $830. This means that with a $40,000 investment, or sometimes much less, you can own a $200,000 asset. If renting the house costs $1,200 per month, you'd have $370 remaining each month after expenses, leading to an annual profit of $4,440. The advantage of real estate is that your asset is effectively paid off by someone else, helping you build equity. The property value appreciates year after year, and you enjoy positive monthly cash flow. Additionally, investors can use the increased property value to acquire more properties, accelerating their investment growth. For example, if your $200,000 property appreciates to $250,000, you could refinance and extract $50,000 in cash to purchase another $200,000 property. This allows your initial $40,000 investment to control $450,000 worth of real estate. Today, bonds are not always considered top investments due to their low returns and sometimes inadequate inflation protection. However, bonds can serve as a protective layer against market downturns, especially as one nears or enters retirement. Warren Buffett, a renowned investor, mentioned that if he were to pass away before his wife, he'd instruct his manager to place her money in a very straightforward yet effective portfolio, 90% in simple index funds like the S&P 500 and 10% in bonds. Finance professor Javier Estrada tested this strategy with historical data and found it outperformed many expert retirement strategies. Estrada also enhanced this strategy to maximize the protective benefits of bonds in an investment portfolio. Since market crashes are unpredictable, having a strategy is essential, particularly if you're financially independent and living off your investments. Estrada suggests that when retired and withdrawing funds from an investment portfolio, monitor market performance. If the market is performing well, withdraw funds from the equity side as it yields higher returns. Conversely, if the market is underperforming, withdraw from the bond side since bonds usually increase in value during downturns, allowing equities to recover. Many profitable businesses are not listed on the New York Stock Exchange. These can include physical businesses like restaurants, coffee shops, franchises, or ATM machine chains, as well as online ventures like apps or software companies. The goal is to own the business without managing its daily operations. Operating a business requires specific skills, and not everyone is equipped to run one. However, many people own businesses and hire others to manage them for a salary or equity in the company. This asset type often involves a higher difficulty level compared to other investments, such as starting a business from scratch or finding businesses needing investors. Alternatively, you could purchase an existing business or franchise. Despite its challenges, owning a business offers substantial benefits, including control over cash flow. As a business owner, you can decide how much profit you take home and enjoy various tax advantages, such as benefiting from the dividend distribution tax, which is usually lower than regular income tax. For example, if you own a multi-store business, you might purchase a nice car using the business's funds, which you can buy or lease with pre-tax money for visiting your stores. Always seek professional advice to understand what expenses are allowable. Have you ever wondered what if you had invested in Amazon 20 years ago? How much would you have now? Or if you had invested early in Uber or Netflix? While we can't go back in time, new companies are continually emerging that could become just as successful. Investing in startups and growth companies can be lucrative, but comes with high risks. Investors typically allocate only a small portion of their portfolio to these ventures, understanding that there's a chance these investments could fail. However, if you invest in the right company, your wealth could grow significantly. All these assets are valuable, but the best investment you can make is in your own education. Real estate can be a fantastic investment for the educated, but without knowledge, it could be risky. Stock investing can build long-term wealth, but lacking financial literacy might cause missed opportunities. Investing in your education lays the foundation for effective investing and achieving the life you desire. Thanks for watching. If you enjoyed this video, give it a thumbs up. Share your thoughts in the comments below, subscribe, and turn on notifications to catch all my future content. See you next time.